Hello and welcome to my channel. Today we're going to look at proposal to base money on bank assets. You might want to start here with the money and banking playlist. And don't forget to subscribe if you aren't already. In the run-up to the U.S. Civil War, many Northerners were looking for a way to reform the banking system. One idea floated around was to base the amount of money banks could issue on the value of their assets. Now this might sound pretty sensible today, given that we reuse to modern accounting rules, which require that banks hold enough assets to cover their liabilities. But at the time, this was a radical idea, since it would tie the money supply directly to bank deposits. There were four schools of thought regarding the multiplication of loaves and fishes. The first of these was that the creation of money should be limited to a ratio of the bank's assets. This was the formula that was tried in the New England states. In Massachusetts, for example, the issuance of banknotes was limited 2-to-1. Rothbard Mystery, p. 211, 2. Grassiclos, Money and Man, p. 184. Loaves and Fishes and Civil War, 363 times the amount of the bank's capital actually held in the vault. Furthermore, this could not be in the form of paper money, bonds, securities, or other debt instruments. It had to be strictly gold or silver coin. Also, the banks were limited in the number of small denomination banknotes they could issue, and in this, Massachusetts served as the model for Jackson's attempted reform at the federal level. By previous standards, and certainly by the standards that prevail today, this was an exceptionally conservative policy. In fact, even during the previous stress of the War of 1812, when banks were failing by the hundreds across the country, the Massachusetts banks, and most of the other New England banks as well, were able to maintain full payment in specie. With the passage of time, however, the limit on banknotes became less important, because the banks now were using checkbook money instead. Their paper notes may have been limited to 200% of their capital, but there was no effective limit to the numbers they could ink into people's deposit books. So the fraction and fractional reserve banking began to shrink again. Consequently, the monetary contraction of 1837 was like a scythe over the crop, says Grassiclos, and 32 Massachusetts banks collapsed between that year and 1844. The state attempted to patch the system by instituting a network of bank examiners and by increasing the liability of bank stockholders for the lost funds of their depositors. But the underlying problem was still ignored. A new crop of banks then sprang into existence, and a new wave of speculative mania swept through the economy. By 1862, even though the law still limited banknotes to 2 times capital, the banks had created $73,685,000 in total money, including checkbook money. This was supported by a base of only $9,595,000 of specie, a reserve of only 13%. Massachusetts had not solved the problem. Now, let's get back to our 4 types of proposals for loaves and fishes. We've covered the first one. Now, let's look at the second. Proposal number 2 was to allow banks to issue money against any and all deposits, not just specie. This is essentially the modern system, except that it would have been established 100 years earlier. Of course, this plan would have been completely unacceptable to the anti-bank, anti-debt views of most of the era. But several prominent economists, notably Simon Patten, favored this approach. In his view, credit-based money was superior to specie-based money because it could more easily accommodate the needs of a growing economy. A third proposal was to base the amount of money a bank can create on the amount of its deposits. Thus, if a bank had $1 million in deposits, it could create $2 million in money. Under this plan, specie would be required for some minimum portion of the deposits, say 10 or 20%, but the rest could be made up of other assets, such as loans or even capital stock itself. This is very close to what is known as 100% reserve banking, except that it wouldn't have required banks to hold all reserves in specie. Nevertheless, such a system would have been much more restrictive than the one that ultimately emerged after the Civil War. The fourth possibility was a compromise between the first and third options. A bank could base its note issue on a percentage of its total assets, which would include specie loans and other items. This option allowed for more flexibility in meeting the needs of business, while still providing some connection between money and underlying economic values. Now, none of these options were adopted, at least not exactly. The post-Civil War banking system did, however, move in a direction that allowed banks to create more money based on a wider range of assets. For more on that, see the next video in the Money and Banking series. Thanks for watching. Please subscribe and give a thumbs up if you enjoyed the video and learned something new.